Okay, we are live. Welcome in. This is the Investing Power Hour on Chit Chat Money. It is 12 p.m. Eastern Time, normally 12:30, although most of you are not watching this live, so it is irrelevant to all of you. My name is Brett Schafer, and I'm joined by my co-host Ryan Henderson on these shows, which again are the Investing Power Hours. We cover all sorts of investing, business, and finance topics with no set script. Today, well, who knows what we're actually going to talk about, but we have a study on dividend pairs. We have tech executives calling for a pause on all AI tools. We have Block's response to the Hindenburg research report, and then an update on the white collar employment recession. Should be fun. But today's episode, first, we need to talk about our sponsor. Today's episode is presented by Stratosphere, our investing home screen for fundamental research. Stratosphere has fantastic KPIs, as Ryan is showing the viewers right now. I wanted to pull up Blocks for the advertisement today. They have all sorts of different segments, including hardware gross profit, Bitcoin gross profit. You can see that one's quite small. You have Cash App gross profit, and you can see it's CAGR'd at a 97% rate for the last 5 years. So when Hindenburg comes out and says that, well, some of those numbers you're putting out might be a bit sketchy, people will get scared. However, we'll talk about that as well. And this is for almost, I believe, every S&P 500 company, all the large companies in Canada, and a ton of companies around the world have, or Stratosphere has built KPIs for them. For example, with Block, we have transaction-based revenue here. We have all sorts of things that you would typically have to make yourself, but they're going to save you time and resources, frustration. When we use it, these are things we would have had to pull ourselves from SEC filings, and that can just take so much time and frustration. So try out the platform for free. And if you want the upgraded KPI tools and long dated historical financials, go ahead and try one of their paid plans with promo code CCM and get 15% off. That is stratosphere.io. All right, Ryan, it's been somewhat of a not busy week. Kind of had tough
I
time
think that's
coming up
just
with
a
news.
recency bias. We're lapping the banking crisis, so I think maybe it's just a comparisons problem.
Let's start out first. This might be a bit of a coin flip since we are outsiders within the industry and it's very dynamic, but was this a fraudulent banking crisis where everyone that called it a crisis was just getting too ahead of themselves? What's your
I think
take?
it,
What's
I
your
think
prediction?
it was what you would call a FinTwit banking crisis, where the normal person didn't really care. They just thought, oh, the Silicon Valley, like people heard about it. I had a number of friends that don't give a rat's ass about finance, ask me about Silicon Valley Bank, but I don't think any of them thought, oh yeah, wow, that is yeah, this is probably time to analyze the interest rate swaps at my local regional bank and then see whether I should pull my totally probably insured deposits out. It's just never happened. Like no one was worried about it. So I think it was, yeah, a manufactured panic that just never came to fruition.
Kind of similar to the rich man's panic, 1903.
And there is more incentive for the rich man in this case to panic because of the federal insurance limits.
Yeah,
Uh,
yeah, I agree.
but I've always thought too, like, unless you're getting ready for a transaction and unless you're like uber wealthy, why do you need to sit on like millions in cash?
Yeah, you can.
Business, it's different. But for the individual, like,
Yeah, you don't have
I
the
don't know.
payroll obligations. So you can just buy, if anything, short-term treasuries. Yeah, it's interesting why anyone would do that. And I mean, thinking about if we were, say, with our investment fund, it's not relevant now because it's so small, but say it became a sizable one 10 years down the line when we have cash positions for our clients or for the whatever the pooled money, if we're over the limits and if we had a significant amount, we would definitely just put them in some sort of money market fund, some sort of treasury, something like that, which is not, that's not rocket science, but it's way simpler to do. And yeah, I don't know. We could just totally be wrong. This could be a giant banking crisis 6 months from now, but my gut tells me everyone overreacted 2 weeks ago and things are going to be okay, except in Europe where the banking situation was already, let's just say, screwed. But let's
Okay, I
go ahead.
remember.
Anything else? Anything else on
No, I
this?
remember looking. I just like. I think I read one article on Credit Suisse, and this was not just an interest rate problem. Like, they had a number of mistakes over the last like 3 years that were huge issues. I mean, I think they lost somewhere in the ballpark of like $5 billion from Bill Huang.
The Archegos, well, was that a fraud? That wasn't a fraud. That was just kind of manipulation, right?
Yeah,
Not a fraud. It was
excessive
market
leverage.
excessive leverage and trying to manipulate the market. I want someone to
But
interview him.
they
I
had
want
a
someone
number
to,
of lawsuit. Like, they had a number of um, lawsuits that came against them of like, I don't want to. I'm not smart enough to go through all the problems because I don't really remember them. But there was not just, it wasn't just negligence here. There was stuff that they like actually did wrong, and maybe some level of malevolence. Um, so I mean, yeah, Credit Suisse had its own problems, but
yeah.
I
All
would
right.
say
Now,
if I'm betting now, the rich man's banking panic of 2023
yeah.
lasted all of about 2 weeks.
Yeah.
When the history books are written.
We should look back because we did look into the rich man's panic of 1903. We should look back into that and see if there's any similarities because I forget exactly what happened, but I don't have the facts in my head right now, but the feeling was the
It was
same reading it.
07, right? It was
No,
1907.
no, 1907 was the real banking panic that, remember, there was all those trusts that were
JP
collapsing and then
Morgan.
JP Morgan had to come in because the Fed hadn't existed yet. So there wasn't a federal backstop and it was all totally disorganized and stuff like that. Whole thing. Check out our show, History of Financial Markets. We cover it very thoroughly. But we're going to hit our topics today. No guests, unfortunately. This
I don't know if you
actually is.
saw mine. Did you end up seeing mine?
Well, for some reason, Ryan, you seem to not see when I make the document. So
I made a wrong document.
yeah,
I made a.
you love making wrong documents for us, but
That's my bad. But
it's
this is
what
better.
is it? What is it gonna be?
It's probably better if you didn't see it. So Amazon reportedly weighing the offer to buy AMC.
Oh yeah, that we'll see if that's rumor, news or noise. But before we get to the topics, yeah, that'll be a fun one. Remember, these go live on YouTube at 12:30 Eastern time on Thursdays. You can also watch the replays right after. And you can watch the replays, yeah, on YouTube or listen on your favorite podcast player of choice. But if you want to watch us on this Zoom call, go right ahead. First item I have on the document is a study on dividend payers. Let me bring this up. It was a nice little tweet screenshot, and I'll share it for everyone so Ryan can see it. Yeah, there we go. All right, this is from Focus Compounding. Okay, yeah, don't show my direct messages. And yeah, they're a great show as well. They have someone, Jeff Gannon, who's like an expert in investing. He seems to know everything. Like, he's just like, whatever. Go listen to that show. It's super interesting. So here's a screenshot from Focus Compounding. I'll bring it up. More return with less volatility, return and risk by dividend category from 1978 to 2022. There are two different charts here, or excuse me, it's a chart with two different, bars. One's one color, one's another. If we look at return and then standard deviation, they have dividend growers, S&P 500, non-dividend payers, and dividend cutters and eliminators. And if we look at the chart, if we go from dividend growers and initiators, they have better returns than the average in the S&P, the average of dividend payers and the average of dividend cutters, where the return, and I'm assuming this is total return for dividend growers, is 13.2% compared to the dividend cutters at 9.4%. S&P 500 total return was 12.3%. And then the risk measured by standard deviation, so in this case, low volatility, if people care about that, was the least as well at 15.3%. And then it steadily goes higher for S&P 500, non-dividend payers, and then dividend cutters. There were some really interesting comments on this one, where some people said, yeah, it's obvious, consistent dividend growers are the best place to be in. And if you own some of those and you buy at the right price, I mean, they can just be great low risk investments over the long term. However, other people are saying that this study is a little bit of hindsight bias, because when you buy a stock that was a dividend grower, it has no bearing on whether it's going to turn into a dividend cutter in the future. You still have to do fundamental analysis on the business. So I don't know. What are your thoughts here on the consistent dividend growers? I kind of like the companies that have the magic of consistent buybacks. They treat the buyback like a dividend, and consistent dividend payouts, where they just do that combination where each quarter we're just going to steadily pay that, steadily pay it out, steadily pay it out. And then over time, if the business quality is fine, we don't need to mess with. So many management teams mess with, like, oh, we're going to buy when it's cheap, and then we're going to sell some stock. And the ones that are consistent, I think, just keep it, they lower, they don't make it too hard. And then that actually ends up being the best strategy over the long term. But curious your thoughts on this, on the dividend growers.
I think the thing about having a dividend in place is obviously it prevents you from doing other stupid things with your money, or your excess cash flow. Now there's obviously still the possibility to do that, but it's a lot. For one, you've now limited how much cash you have, less cash than you would to work with, because you've committed to paying out the dividend to shareholders. But it's also, I think, harder to revoke, or it's more difficult on the stock price to either pull back on than a repurchase program. A repurchase program, you could put it in place and then, kind of be, I don't know, nonchalant about it, or say, oh, why don't we stop on a good example here is probably Match Group. Match Group could be buying back stock, but they're kind of a little shaky about it.
Yeah, they're off and on.
Yeah. If they had a dividend in place, there wouldn't be stopping and then restarting your dividend is a lot harder to do than just like pausing your repurchase program. So
is that good or bad? Is that good or bad though?
I think it's good because it prevents people from doing stupid stuff, and the majority of management teams do stupid stuff with their capital.
Yeah, and then what investors what I've heard as pushback to that is, well, what if the business becomes worse and then the dividend payouts become unsustainable and they're using debt to do that and stuff like that? And my thought is, well, don't own it. That's pretty easy to see, that if they're not funding it with cash flow, then
but also
you can sell it. So that has nothing to do with what, right? You should still do the fundamental work, if that makes sense.
I know if the business is, if the concern is that, well, what if the business is in decline? Okay. I think with or without the dividend over the last 10 years, the business would probably still be in decline.
Exactly.
And at least you got cash along the way. Like if it's growing, I think the difference here is that a lot of businesses chose to put it back into employees or executive compensation or acquisitions that didn't make sense, as opposed to just paying out the dividend. And even at steep multiples, paying out a dividend is just a good way to not do something stupid.
Yeah, exactly. Look at the CPG CPG companies sometimes do stupid things, but okay. Here's, I think, the pushback. A lot of replies were to this tweet, which I think were quite smart. I didn't think about it at first. Here's a response from compounding investors. Well, there's about 10,000 of those on Twitter. Clearly survivorship bias at play in that analysis. You can't know in advance if they will continue to increase their dividends or stop at some point. Easy to say with hindsight, but impossible to say in advance. I think my question to you would be, and maybe I'll have some thoughts on this as well. What are some strategies or ideas for finding these prospective dividend growers, a company that is likely to keep growing its dividend per share, I'm assuming, say for a 20-year period, sort of like, historically a Coca-Cola, a Pepsi, some of the tobacco companies. I'm forgetting, there's plenty of others that I can't think of at the top of my head, but what are your thoughts on that?
Well, I think generally companies that have raised their dividend over history are, and as long as cash flow to the business is still growing, are more likely to raise their dividend in the future too. And it always
Yeah.
seems like if they've raised their dividend for 20 years and cash flow has grown for 20 years, it's probably going to happen over the next 5. Unless it's like some business with like a huge terminal issue or something like that's being disrupted. But I think those are good indicators. Companies that recently, probably within the last 5 years, initiated one, probably have room to grow it. There might be more companies where there might be some companies where it's difficult for them to grow it because they've kind of been doing it for so long and maybe the business is in some sort of a difficult situation. But I would say trying to identify dividend growers is look at companies that have raised their dividend in the past and simultaneously grown cash flow. Obviously, you don't really want like some huge dividend payout while cash flow is diminishing because that, that means the business is probably in a difficult spot. Or recent initiators. If you're a recent initiator, it probably means you have the excess cash to continue paying it out and paying more of it out.
Yeah, here's I think the 3 criteria I would have, and these are probably the most basic criteria, but it's really harder to find than you think. 1, history of consistent cash flow generation. 2, history of consistent dividend payouts, because if they have the consistent cash flow generation and they weren't paying out the dividends before, I don't know if you should expect them to continue that in the future. Maybe they're wasting on M&A. Maybe they're being inconsistent with buybacks and buying back a ton at a super high price and not buying back, they're buying high, selling low in their own stock price. And then third, and this is the hardest one, is doing the fundamental work and saying, is this business still going to have that durable cash flow coming to it in the future? And if you can kind of answer all 3 of those, I think that can be a really good dividend payer. We have a comment here. I think, I agree with this. This is from Lars. Thank you for joining. Says, looking backwards and selecting only companies that grew dividend is like saying companies that grew their earnings per share perform better. As you said, there's no way to know that they will continue doing so. I think, yeah, it's good to look at the ones like Ryan said that pay the dividends, but you also have to have other criteria in there. You can't just go, oh, dividend high, I'm going to buy. No, you have to do a little more work than that.
Yeah, I think that's accurate. I mean, you still have to, unless it's like a crazy dividend payout, like, I don't know, 20% or something like that, like a dividend yield. You got to believe that the business is going to grow over the next 5 years.
Yeah, I agree. All right. Other comment from Sandeep. Here's the question. Do you guys think the recent closing of a business unit at Nelnet has an impact on its intrinsic value? Yes, but pretty darn small. I would listen to our full show on Nelnet that we go for over an hour, kind of going through the ins and outs of the business, why we own it, what the big risk we saw. And this was one of the big risks we saw, where looking at that student loan servicing business, we really applied a very low single digit multiple to it because the regulatory stuff is quite shaky, and that's what happened to them this time, where they lost some earnings on that. But again, it's going to be small compared to the size of this business. Hopefully that covers it. Ryan, anything else to add there?
Yeah, I think closing of a business unit might be a little inaccurate.
That is inaccurate. Yeah.
The business unit, so Nelnet Diversified Services, I think that's the one. That's the loan servicing. That's still operating. They had like 17 million borrowers or something like that. Now they'll have 16 million borrowers. The federal government took some of that and gave it to a new loan servicer. But the price per borrower is coming down as well. That's more of the concern, and they laid off some people in association with that, which makes sense. But I wouldn't see it as like a huge, like they're not closing the whole business unit, and on top of it, not all of their borrowers that are using or not all of their loan servicing customers, so the people that are using Nelnet to basically pay for their loans are federal customers. So not all of them are under the FFELP program. And so there is still value to that business aside from just the federal student loans. It's much smaller, but there's still like 20, I think it's like 25% of revenue comes from non-federal customers. So there's still some value in the business, but yeah, we think it's kind of a small percentage of Nelnet overall.
All right. Do you want to talk about the fun topic? Amazon apparently, and I'm putting in apparently air quotes here, is going to buy AMC not AMC Networks, excuse me, AMC, the theater chain and the meme stock. What were the sources here? Who was reporting this? Maybe get into that, because I'm already gonna kind of call BS on this.
Yeah, I think it's right to be skeptical. So the initial source was and you're gonna laugh when you hear this, a Substack called Intersect, or The Intersect. It's run by a guy named Joe Del Bruno, who used to work on Wall Street. I'm not entirely sure on his background, but basically he had sources familiar with the matter. Here's the quote from his Substack. Amazon founder Jeff Bezos has dispatched his investment advisors and top entertainment chiefs to explore acquisition plans for embattled theater chain AMC Entertainment, according to multiple senior sources familiar with the discussions. Now, this might just be some random rumor.
That's all they got.
I think he talks about like having insiders at the company throughout the article, and he talks about some of the rationale. The thing is, like, Amazon didn't comment on this at all. And maybe it's not large enough to comment, but when the EA news came out that they might buy Electronic Arts, I think they shut down. They said we have not had any of those discussions.
So the fact that they didn't say anything shows they might be in some talks. Maybe they just buy the.
I don't know if they said anything for Peloton, so it might depend on like the size, whether or not, because like someone could just start a rumor any day.
Yeah.
But yeah, I would be skeptical of this. I mean, I think embattled theater chain is a good way to describe it. Obviously, theaters are kind of up against a difficult just operating environment. And I love theaters.
Not when Air and the Mario movie comes out. We got two movies I'm interested in. The biggest dad movie of all time, Air, and then the Mario movie is going to crush. But no, you're right. I mean, it's
I still
such a tough. Yeah, it's so hard, but they're not making any money off of you. It's all going to whoever. It's Disney, right?
They're just getting. I mean, they're going to get squeezed. Like, I think that's pretty foreseeable. That with all the access to new movies right from streaming providers, it just like it's going to be a tumultuous like next 10 years for them, I'd imagine. Blockbuster was still a business that a lot of people liked, but
yeah,
just
at the right price, and I'm assuming this would most likely be a price of just giving the debt holders some value at the right price.
How funny would it be if sorry I interrupted, but how funny would it be if they said they're going to bid for it and they just like bid half the price and Adam Aaron sold?
Yeah. Well, that might be. I mean, he's got a fiduciary responsibility. Wow, we don't need to get into the meme stuff, but does it fit within that business? Because I could see some arguments that it does fit within their media strategy because they're trying to do stuff, but I also see like this is not going to help them succeed. They've really just been throwing a ton of money at, Fire TV, Amazon Video, sports, and basically the home screen stuff. outside the hardware for Amazon Fire TV.
Yeah, you can make
And
the case that like somehow
yeah,
there's some parallels between them and Prime Video. But you could also make the case that this is at direct opposition to their strategy, which is
yeah,
streaming video from the home.
yeah. And maybe I think there's a possibility where they could make it, Prime members get a benefit and stuff like that, and they increase the value there. But is it really going to move the needle for them? I don't think so. And
Yeah,
yeah, it's
okay, the
hard.
other
I
thing,
want to know what's going to happen with the whole media division within this company, because they're making a lot of big deals. They bought that MGM asset, which is had James Bond, a few other really historical, well-known franchises. They had made the big deal with the sports stuff, and they're increasing potentially their sports commitments. I just want to know what their long-term strategy is here.
well, the concern for me, more so than anything else, is the headline here. Amazon founder Jeff Bezos has dispatched his investment advisors. Is he
I
really
don't.
still calling the shots capital allocation wise?
I'm a bit skeptical on who that source is.
Yeah. Um,
He seems to be, quote unquote, living his life on his yacht. So I doubt it. But that would be concern if he was kind of pulling an Iger and stepping in still.
or maybe not necessarily stepping in, but just like kind of treating Amazon as his piggy bank to buy what he wants. That would be more
Yeah.
concerning. But I just like mm, throughout all of Bezos's history, he's never really been that kind of a person. So I have my doubts. The
Yeah,
other thing,
reading the two books, that does not seem like him. But I think as the executive chairman, he still probably has a say in capital allocation. There's nothing wrong with that.
yeah, that's true. But it made it sound like it was just basically his decision. Like he's dispatched his investment advisors, like Logan Roy or something. Like go buy it.
I
You
just
know.
watched this new episode of Succession. We need to
Oh, we gotta
scale
have the
up.
Succession wrap up. You
Yeah,
gotta
maybe like
integrate that.
once. Yeah, if we have time at the end, if we should talk about it.
No,
Yeah, I mean that was so fun. It's a funny episode. I'm gonna pull up some Amazon stuff on Stratosphere and see if there's anything interesting. But yeah, keep going.
yeah, to me it doesn't make a whole lot of sense. The acquisition or its rumors, especially at a time when they're closing or shuttering a lot of their sort of other bets type of segments, or there's at least big layoffs in those segments. It would feel weird for them to just bet on something like this randomly. So yeah, my gut would be that this is wrong. However, Amazon hasn't shut the idea down officially. So it could be. I guess it's always possible. AMC stock, unsurprisingly, did jump on the news. Here's the thing that's frustrating to me.
Well, that is a manic. I mean, that could be at 20% any day. I'd be like, oh, there's some, someone's doing something. But
How it's so literally anyone can come up with these rumors and it affects the stock. It's mind blowing. Like
it's like a hot potato. So yeah,
it's happened with Amazon a number of times now. Remember when they made the rumors about Peloton? Peloton stock jumped. Remember when they made the rumors about EA? Stock jumped. Now AMC stock jumped. It could be anyone. There's like all you have to say is sources familiar with the matter told me, and the stock will jump. It's
yeah.
remarkable.
Sources familiar with the matter, that entry level employee in HR that I vaguely know, friend of a friend. But here's a nice screenshot from Stratosphere that kind of, I think, and not all of this is obviously media, but a good chunk of it is. Amazon subscription services revenue since 2014 has grown at a 37% compound annual growth rate and is now at $35 billion a year. They have a lot of wiggle room to make mistakes here and make some big investments within media. I just wonder what that long-term ROIC is going to be like. How are they going to, because you
What do you think
can't
the margins are on subscription services?
it depends. Well, it depends. It depends how you calculate. I'd say pretty high in a vacuum, but if you realize that some of that's going to fund delivery costs, then it's hard. It's pretty difficult. But I
Yeah,
think they're
that's true.
still spending. And look, the numbers they have a lot of numbers. So without the numbers in front of me, I could be way off. But they're spending what upwards of $10 billion a year on video content for Prime Video. So that, I mean, they can't be that high. And then music stuff that has variable costs. So I'd say it's pretty good margins if you don't include delivery fees. But then a lot of it is going to returning that surplus. But I think here's the question though: if they have all these new media assets within the subscription division, are they going to be able to drive this bundle and raise prices for everyone over time without increasing churn, or are they going to have to maybe separate out the Prime subscription more, where you have these add-on stuff, outside of the course thing, if you get what I mean? Because not everyone likes to go to the movies. If they add something like this, if you kind of get what I'm saying here.
The only add-on that I know of is the RX stuff.
There's also Twitch. No, there's a lot. I mean, you can subscribe to Showtime, a lot of streaming services
Oh, and it's just like an additional 10 a month or something like that.
or whatever it costs. Yeah.
Hmm.
I mean, grocery.
I hope
I
that's
think
not the
grocery
case,
isn't.
but
Yeah.
the
Either way, they got a lot of recurring revenue coming in, and a lot of, and this is a good or bad thing, a lot of money to throw at stuff to see what sticks. And that seems to be their strategy. And that's probably the most, full disclosure, we are shareholders today. The most frustrating thing as shareholders is, how about we focus on like 3 things and then print money for a while and maybe, have a couple of long-term projects, but they're like, no, why don't we just buy some movie theaters? That's good infrastructure.
I did see an interesting stat that I think Prime has now more than 200 million subscribers globally, which
Wow.
was up. I'm pretty sure that's up significantly from like the last 2 years.
Yeah.
What is the number one thing you subscribe to Prime for at this point?
Delivery. Same. I don't watch Amazon Prime Video.
You don't watch Thursday Night Football?
Except Thursday Night Football. That's the only time I'm on there. Yeah.
They said that was a big driver of Prime subscriptions, which is kind of
Yeah.
surprising.
Well, I don't know if that's surprising because there's the core football fan that watches all the games. And if they didn't have it, they're going to get it then. So I don't think it's very surprising. But I mean, the key value drive is the delivery. I think it's worth, to me, $300 a year, at least, just from all the time it saves me dozens of hours.
Yeah, I agree. I got some other news too. Lululemon reported earnings, and EA is laying off 6% of their staff.
Yeah. Yeah. What do you want to hit?
Let's talk Lulu, because I gotta say, this might end up being the one that got away. I hate retail, but they seem to just have unlimited pricing power. They
Yeah.
can, like, their comp sales are really pretty remarkable,
Yeah.
and it's
I
been
don't know.
steady.
It's so hard for me to like analyze them. I just don't like, the numbers always look good. And it feels unpredictable to me. Like they're executing phenomenally, but I just don't know. It's in the too hard pile for me.
I think Under Armour has just scarred you from retail forever.
No, other ones. And just the fact that I don't know, I'd buy Nike at the right price. Which is pretty low given the China risk, but Lulu, look, there's a difference between executing phenomenally and they've executed so well. The growth in men's has been great. But like, this is a business. If they get a new manager in, I think they could screw it up within a year.
I don't know. It feels like they're kind of, with retail, it feels like there's this chasm between like chasing the trend of whatever's popular at the time and sort of being the retailer that determines the trend. And I would say for men's retail, and probably women's too, Lululemon feels like if I go into that store and I see something, I'm like, I guess that's what's popular now. Like,
What's
maybe
their
that's what I
men's
should get.
what's their men's revenue? Do you have it?
Go to Stratosphere
Yeah.
right now.
Yeah.
I mean, it's gonna
Because
take a second.
I can't I mean I think you're maybe blinded by your personal habits because the apparel
It's true.
industry trillions of dollars, and if they're only doing like $1 billion in men's revenue, I do not think they're setting the trend. But obviously the growth there has been phenomenal.
Probably is something like 1 billion, but let's see here. Men's product revenue,
Sure, that's you want to
two
share the
billion.
screen?
Yeah, basically 2 billion. It's grown at 30%. Oh, shoot.
Oh,
Like,
go full screen.
oh my gosh. I'm trying, but
Yeah,
Zoom
yeah,
loves to get in the way. Yeah.
yeah.
2 billion, roughly.
30%. Yeah, I mean, let's see him get to 10 billion before we say they're the trendsetters. But I mean, obviously, 30% growth there is super strong. What's their United States revenue? Getting closing on 6. Yeah, I mean, they're escaping the subscale and becoming one of the few scaled brands out there. I mean, who are the scaled ones outside of luxury? There's Nike, obviously, Adidas.
I think Lulu might do more than Adidas.
No way. No. Soccer cleats alone, or come on.
I'll check it. But yeah, I'm probably wrong on that, but I wouldn't be surprised if they did more in earnings. Adidas.
Well, after the Kanye stuff, it's possible, but who knows? I also could be talking out of my ass. Yeah, Lulu's it's an enigma to me. It's an enigma to me. I just can't get, it's one of those like other people might make a ton of money on it, but I just can't get comfortable. I just have no insight of whether the brand is strong or not, besides like, oh, a lot of people are wearing it right now. But the competitive, I can't just be like, my competitive advantage can't be girls think they look cute in the outfits. There has to be something else there for me.
Why it works.
Yeah, but like
Don't
I
fight the
can't.
trend.
Yeah, it's just not something I like. Look, like I said, other people can make money in it, but it's not something I feel comfortable being good at.
Yeah. No, Adidas is much larger in terms of product
Yeah,
sales, but
come on, you're a messy guy. Come on, messy stuff alone. The messy ads alone probably pay for that.
Lululemon does earn more.
Yeah, well, normalized, you know.
I don't know if there's a normalized here for. I don't know what the normalized would be. I would say it looks like kind of at their peak. I
What
don't know
about
what the peak was.
you have a gross profit number?
Um, yes, it's loading. 11 billion in gross profit.
Yeah, that's double Lulu's revenue, right? Or was that just US
It's not
revenue?
double their revenue. No, they have like
8?
8 billion.
Okay, but it's more. That was US only that you were looking at.
Yeah.
But yeah, they're catching them.
Yeah, I would not be surprised if they were larger in the future, although the valuation is a little steep.
Yeah, that's also tough for them. It'll be interesting to see if they can succeed in footwear because that is such a big market. Lululemon, I mean.
Yeah, I mean Adidas certainly has succeeded. Other one that's kind of interesting is EA laying off 6% of their staff.
Yeah, I also saw Roku. Yeah, EA. It looks like Roku's doing it again. I saw a couple of others. It seems it's just a consistent flow each week, and it seems like during this kind of white collar recession that got kicked off, or maybe it's just a white collar popping of the bubble because we're not really seeing any true recession indicators yet. But the white collar, let's call it slowdown, that who started Meta, the big tech companies kind of started it. It's giving these other companies wiggle room to get rid of stuff that wasn't working and where they might have overhired. Because when we're looking at the stock reactions, typically when someone lays off their workforce, that shows that something totally went wrong. But a lot of times now we're seeing this flat stock price, no reaction, even the stock might be up. So when the companies are laying off, if they're within a certain sector, within tech, usually consumer internet, I'm thinking, okay, this is probably a good thing because most likely, if they're like all the other companies that we've heard stories about, They hired too many people in 2020 and 2021 when the bubble got the best of them.
Yeah, I mean, a lot of them were hiring people to hire people, you know? Like,
Yeah.
they were literally hiring people to be in charge of hiring. I know every company's got like hiring coordinators, but like, there was, the
Not
more people you
Berkshire.
hire,
Not
the more
Berkshire.
the more, let's say, developers you hire, the more people you have to hire in order to get them acclimated to the business. And it just becomes this horrible, like, you need people to manage people.
Yeah. What did we say? What did I come with before? We need all these people to manage all these people.
It's
It's a yeah.
shocking that it took so long for people to realize that a lot of people leads to bureaucracy, makes it more difficult to operate efficiently. Like, you're not, maybe not as quick. I mean, Mark Zuckerberg sent that whole letter about it. He's like, wow, we just learned how much better we can be with less people. And so they laid off more. And it's not like I'm like rooting for these, because I don't want to be that person. I mean,
Yeah, for the individual
my
job, yeah, you
occupation
feel
is not
bad.
very noble, but
Yeah, you feel bad when someone gets laid off individually, but as an investor, you gotta look at it through an investment lens.
I'm also not rooting for them to overhire. I like, I don't think it's ever a good idea for businesses to have more people than they need.
Yeah. Do you think it's funny that
It's not good for
McKinsey?
them. It's not good for the
Uh,
company.
yeah. Do you think it's funny that McKinsey, which is supposed to pride itself on economic forecasts, is now laying off like I don't know how much of this is their staff, could be a small amount, but like 1,400 people? Isn't I know I'm a McKinsey basher, but you're supposed to be the economic forecaster for all other companies, and yet you're going to lay off people because you made a mistake in overhiring. Maybe, just maybe, it's all just BS, and consulting just outsources the risk that you don't want to take in as executive team.
The Match Group's down 6% today. For what reason?
I think it's probably end of quarter rebalancing.
Yeah, it's down like 7%. All right. Well, we are going to be doing a show tomorrow on Match Group, so that'll be kind of interesting.
Yeah,
Coincidental
I mean,
timing.
I think end of whenever something's moving without news that you can immediately see on the last day of the quarter, got to be reshuffling for funds.
You know
Because
what we should have looked at? Sorry, I'm all over the place today.
go ahead.
Commercial office real estate stuff.
For what?
People asking for bailouts.
Yeah.
And it is an interesting idea that what kind of ripple effects would this have?
What was give some context? I'm a little confused.
I'm not, gosh, I'm going to sound so ignorant on this, but some guy came out who was like a head investor at some big firm that like invests in commercial office real estate. And apparently a bunch of renewals are coming due and a bunch of stuff's coming up where the projections are that nothing's going to get paid and basically they're going to lose tenants. And so this guy called, he said, like, this is going to be systemic. The government needs to step in here.
Was this on like CNBC? One of those guys that I think I kept
No,
seeing.
this was like all over Twitter. He
It was
may have
just
gone on CNBC, but
it was it was a letter he sent or something, like posted publicly, something like that.
I'll try to pull it up. But it's, and then a whole bunch of commercial real estate people were like, yeah, that's, that's, we need this. Like, this is a problem for everyone. And I'm like, this is a problem for you. It's not, like, you can't get, I don't know. It frustrates me when
I can't, yeah, I can't stand that shit.
you
They're
shouldn't be
so
bailed out
rich.
on investments.
I know. They're
And
so
people are like,
rich.
well, oh, you were like sort of a fan of the bailout for Silicon Valley Bank. I am a fan of depositors being made whole.
It's FDIC is an
Like, it's
insurance.
different.
The banks paid for it. The FDIC insurance pool was used and it's going to get raised. So the banks are going to pay for it through their profitability numbers. But yeah, I mean, look at commercial. Look, I can't stand when someone made an interest rate bet and then is like, "Oh my God, bail us out." I just can't. It's so. how do I
Also,
say it? Oh, I hate this term because people use it for political nefarious reasons, but it's so elitist. It's just look yourself in the mirror. Oh my God, you're going to be worth $10 million now instead of $100 million. Wow. Like you'll be fine. How about we make shelter and office and whatever costs, real estate costs, affordable for people in this country? You know what I saw is that, and this is probably true for many markets across the country. In Seattle, our home market, with interest rates up, affording a home is now twice as expensive as renting. It's just out of the picture. Think about how expensive is rent. Rent is there too. It's like we'd have to pay twice what we're paying now to own a home. But sorry, I went on a
I
tangent there.
do think, well, I think owning should be more expensive than renting generally
Fair, yeah,
because
fair, yeah,
ultimately you end up owning the asset over however many years. But yeah, double like just doesn't make sense. I I mean, there's obviously just less buyers out there. Like most people just can't afford it. It's like the
yeah,
reality. But at the same time, I'm starting to realize, I think I'm starting to come to grips with the fact that everyone kept saying there's a shortage of homes, and they were saying that kind of at the peak. And I kept thinking, well, yeah, there's a shortage now, but there'll be maybe an inventory glut when things get worse and there's less buyer demand, but we're still not seeing it. So either
yeah.
people are just sitting on these homes and don't want to sell because they're not getting the prices they were quoted at, or there truly is a shortage and there isn't enough homes being built. I mean, at least in our kind of Seattle experience, I'm seeing way more rental places being built than homes.
Oh yeah, 100%, 100%. I think that's in the data too, but I don't have it in front of me. It'll be interesting to see how the variables go, where there's that difference between how much it costs to buy a house or finance a house versus rent, and whether rent goes up or housing costs go down, whether the supply of rental properties skyrockets because of people opening up their low rate mortgages for rent and all these new apartment buildings that are getting built across the country, or if the supply shortage restricts stuff again because or there's just developments in that with that dynamic with the people that are locked in on their low rate mortgages. There's a lot of variables, and we'll see. It'll be interesting to follow. Yeah.
Okay, I've got the thread. So this is from Scott Reckler,
You want to share it? You want to screenshot
chairman
it?
and CEO of RXR, director at the New York Fed,
There we go.
a whole bunch of credentials, really. He says there is $1.5 trillion in commercial real estate debt maturing in the next 3 years. The bulk of this debt was financed when base interest rates were near zero. This debt needs to be refinanced in an environment where rates are higher, values are lower, and in a market with less liquidity. I have joined in calling for a program that provides the lenders with the leeway and the flexibility from regulators to work with borrowers to develop responsible, constructive refinancing plans. A similar program was implemented in 2009 and during the heat of COVID-19. This program will provide time for the markets to settle and enable the private sector to address the deleveraging that is required to reflect the new interest rate regime. I'm not going to go through all this. He did go on a number of platforms and like CNBC and say all this stuff. Thoughts?
Well, I would like a refund on my stocks that went down 70, my growth stocks that went down 70%.
Yeah, I didn't know interest rates were going to rise.
Yeah, I didn't know. I didn't know that they weren't going to do well. So I would
And
like a
actually, in
refund
my
on that.
model, I had an
I,
expectation that the rates could rise, but the stock still dropped. So it's not my fault.
yeah, look, I don't know what's going to happen here. Don't know the real estate market that well. I know one thing about the real estate market, though, is that there is a metric ton of regulatory capture, and all these real estate investors get tax write-offs, get so many favors from the government. And I would not be surprised if this happens again here. I just can't believe that that's the excuse. Oh, we made some bad bets, and now the Fed is
No, it's not we. It's the adverse environment was not accommodative to us. That's not fair. It's not our fault. The issue, okay, yeah, the issue I take with this is that I really doubt when they were modeling the financial prospects for these properties they were going to buy. I doubt they were saying, well, assuming rates stay at zero forever, our property will be worth yada yada yada. It probably said our rates will rise, but our property just won't be as affected.
Yeah,
And everyone thinks that. Everyone thinks that they're going to be better off in a rising rate environment.
they're bag holders. These urban real estate, what are the charts that have been floating around on the urban real estate, commercial real estate occupancy rates? They flatlined and now they're going in the wrong direction as kind of the market redevelops after COVID, and some people are choosing other cities. And
Hey, we're
we've
moving
had,
out of an office.
yeah, I mean, it just wasn't worth it for us.
Probably
You know,
devastating for
that
we
would,
are causing this crash.
yeah, like, I think I don't know. I wouldn't touch the commercial real estate market with a 10-foot pole. There's no way I'm touching anything in real estate right now because there's not, like, unless you have some sort of differentiated opinion or whatever you call that, there are so many variables at play right now that I don't think anyone that has any sort of prediction, where we've been kind of talking about the risk of a housing downturn and how residential real estate prices might fall, we could totally be wrong on that. And that's really not something we actually have an investment thesis on. But if you're going to make an investment in this space, I think you're being a bit foolhardy right now because it's the most uncertain I think it's been in a long time. There's so much uncertainty. Who knows what the Fed's going to do? Who knows what supply is going to do? Who knows what all these companies are going to do with their workforces? Who knows if there's going to be a liquidity crisis? Who knows if the government's going to bail us out? Like, and
You're
other stuff
talking
I'm missing.
commercial.
Commercial, yeah, specifically with that, but also some of that affects residential too.
Yeah, commercial. I don't know. The difficulty is, would it be? Obviously, I don't think it'd be a good idea to just let every single commercial real estate place fail and have all these.
Why not? Put them in
Maybe not.
receiver. Put them in. It's like the banks.
Maybe
Put them in.
not the investment firms, but um, you're just going to have all this wasted space. Would be my thought.
Well, they just I mean, they refurbish into residential. That's what they're doing with a lot of that stuff now. And it'd be better I think better for the country if the downtown areas had much more residential areas, because then the neighborhoods are much more lively. It's more enjoyable for people, but who knows? I'm just a guy.
Plus, the affordability issue would maybe resolve itself.
No, we can't have that. We need landlords need to make money. They need to make money.
Have you seen the stuff about tipping landlords?
Oh God, I can't with this. That is just
I think it's more of like jokes.
It's just a joke. Yeah.
Yeah, it is funny when you see that stuff. Like, now, don't get me wrong. I don't think a lot of landlords are hated like they shouldn't be. I don't,
I hate
they're
it too
just
much. Yeah.
managing
Yeah.
an asset that they are trying to invest in. But I don't have. It's just an
Sympathy.
investment.
Yeah. Yeah. You could be wrong.
Does everyone sympathize for me losing money on Spotify?
Yeah, exactly. It's like you made a bad bet. Boo hoo. All right. You had the fact that you were able to make the investment in the first place shows that you're one of the most privileged people in the world. So I have no sympathy for you.
Yeah. All right. We've been harsh this episode. So
sounded fun.
Let's do something
I got
more fun.
okay. Well, no, my other ones were whether these AI models are going to eliminate all software jobs, because that's what some person predicted. But let me just share. I'll maybe write about this more in the Sunday newsletter, which anyone subscribe to our newsletter. We have it in every show notes. It's free. But let me just share the screen on this chart real quick and see what you think. Let me zoom in. Come on. Zoom in. You see it? Okay. And
Yeah, I can see it.
for the listeners, they have a 2x2 matrix of different types of jobs where you have predictable and grammatical versus disorder. So it's basically like creative versus uncreative versus kind of, busy work jobs. And there's one, the top right matrix, which is predictable and grammatical. And they think, this team of writers on Substack thinks, that within that graphic is what these large language models and AI tools, the new AI tools, will disrupt. And within that one are software engineers, tax prep, call centers, and contract stuff. So I'm assuming like people that prep contracts. I don't really know exactly what that one is. And the big one is software engineers, because they're expensive jobs and there's a ton of them out there, especially in the United States. And they believe that because these language models are extremely good already at writing code, that there's going to be a huge unlock for companies, small and large, as the cost of developing software goes down, similar to how Moore's law worked with computing.
Rest in peace.
Rest in peace. Yeah, legend Gordon Moore. There you go. But I know you're a software expert, but does this make, as a generalist, does this make plausible sense to you as we close things out here? We got about a minute left.
Pretending to be a generalist, or calling myself a generalist and then talking about software engineering, I just feel wrong doing that, because
what if they're right? What if they're right? Does this help corporate profit margins, or does it just even out throughout the economy?
I guess it would help.
I feel like there would just be a giant consumer surplus of software is much better. You can deploy it much better much quicker around the world, and margins would be higher for some of these companies. They could price things lower. I don't know how it's going to shake out for like stock prices for any of these things, but I feel like if they're correct, and you don't need 1,000 software developers to develop something, you just need 10 plus these AI tools. I don't know. It seems like that would be a great benefit for the world.
Sounds mildly dystopian as well, but
Why?
it's just a bummer for all the software engineers that spent time developing the AI to replace them.
Yeah, but I don't have much sympathy for. Look, I have more sympathy for them than real estate investors, but this has happened to jobs plenty of time. I mean, if we look at since the Industrial Revolution, this has happened to all blue collar jobs consistently. And now it's finally coming for white collar jobs. And I think it's kind of interesting, but who knows? Who knows what's going to happen? This is probably the top of the hype cycle. So I'm guessing it's either going to take much longer than people think, or we're at the top of a bubble or a hype cycle.
I'm calling.
You're calling hype cycle here?
Yeah. I have seen so much now about people talking about how AI is going to replace everything. Obviously,
time for a thread, baby. Time for a thread.
It's been going on for the last 20 years. This conversation, probably longer. I'm not seeing it occur. I haven't really seen it occur in at any sort of large scale where it's replacing employees.
Yeah, yet. TBD on that one, but I remember
maybe there's like small use cases, but
now there's examples of in the 1950s and the 1970s, I think like 2000 of these mini hype cycles that happened about AI replacing all the software jobs. So this one, this time could be different, but this has happened before and they've been completely wrong.
We're at peak AI so far in history. Obviously, it's kind of always evolving, and peak employment.
Yeah, that's true. That's a good way to put it. All right, let's close things out. I'm sure we're going to talk about that throughout, future episodes. Commercial real estate's going to be fun to talk about. We didn't hit the Square research report or the comeback on that. I mean, there's tons of stuff we're going to talk about over the next few weeks. Thank you guys for listening. Remember, we are not financial advisors. Anything we say on this show is not formal advice or recommendation. We are general partners at Arch Capital, and clients may hold securities discussed in this podcast. Follow us on YouTube every Thursday. It comes out live at 12:30 p.m. Eastern time. Give us a review on Spotify or Apple Podcasts, and subscribe to the free Chit Chat Money newsletter. Thank you all for listening and watching. We'll see you next week.